Hello, good morning. Welcome to Retirement Income Journal's second webinar this month on the indexes in the index annuities that have become the most lively part of the annuity product family. We have two guest experts this week. One is Laurence Black, founder of the Index Standard, a relatively new firm that analyzes and assesses the volatility-controlled indexes that have added a whole new dimension to fixed index annuities. We're also joined by Tamiko Toland, Director of Retirement Markets at CANNEX, the go-to source of annuity product data in the US and Canada. That includes data on the indexes in the products, and that's why Tamiko is here. And she works with Laurence as in kind of a professional loose partnership. Thanks for joining us, both of you. To quickly frame our discussion, fixed index annuities, or FIAs, are among the financial products that advisors and agents recommend to risk-sensitive investors, especially those near or in retirement. FIAs traditionally obtain yield through the purchase of options on an equity index. Increasingly, as a way to outsmart the impact of the low interest rate environment, FIA manufacturers are using volatility-controlled and other hybrid indexes in addition to the familiar S&P 500 index, the Russell 2000, and the MSC EAFB index for global exposure. But many advisors still do not understand these volatility-controlled indexes or are skeptical about their ability to add more upside to the performance of FIA contracts, or they're waiting until they establish better track records in order before adopting them. But adoption rates are going up for the hybrid indexes. But still, many advisors still stick with what they understand. Now, Laurence, is that a roughly accurate picture of this corner of the annuity industry right now?
Yeah, correct. I think you're right in that the adoption rates are going up. Mm-hmm. And advisors are now, looking at the S&P and understanding that they need to diversify away and that they're considering other options. Mm-hmm. The other thing that we see is that the option budgets are decreasing from the insurance companies. So they're also then beginning to look at these hybrid indices that offer better participation.
Mm-hmm. Okay, so before we dive in then to the details, let me just give both of you an opportunity to give us a capsule of who you are and what you do and where you come from. You can take it. Why don't you take it first, Tamiko?
Great, thanks. So I work for CANNEX, which is the premier provider of annuity data and pricing and analytics across all different chassis of annuities.
Okay.
Thanks. So my name is Laurence Black, and I founded the Index Standard about 2 years ago now. And what we do is we provide ratings and forecasts on indices. And I founded the Index Standard because what I'm finding is that there's more than 3 million indices, and they're just getting very complex. So with our ratings and forecasts, we're trying to bring transparency and really help people understand the indices. And also just to add, we're an independent provider, and we don't have partnerships with anyone.
Mm-hmm. Did you say 3 million indexes?
Correct. There are now 3 million indices out there, and it's become a huge industry with the growth of all these passive ETFs and what we see in the insurance space. So it's tremendously complex as well.
Mm-hmm. But it's a small subset of those that's available on fixed index annuities, right?
That's correct.
Yeah. Okay. Okay. Just for a visual to maybe orient some of the members of the audience that are not as familiar with this industry. The way I look at it, the way I picture it in my own mind, I think of this as kind of an overlap of the structured notes and the fixed and indexed annuity industries. The structured notes, both of them use options on indexes to generate a return. They make a kind of bracketed, protected bet that depends on the price of options, which depends on volatility levels and interest rates and other factors. And they both rely on, usually they both can rely on indexes. I think the structured notes have a wider range of assets that they can be attached to, but both use options. But options on index is common to them both, and you now see platforms that used to just issue structured notes like Simon and Halo and Luma Financial Technologies that now offer structured notes and fixed indexed annuities. Okay, that's the world we're in. And just to reiterate Laurence's point, the indexes used in fixed index annuities were traditionally these four, or that's the four I'm most acquainted with: the S&P price index, the Russell 2000, NASDAQ 100, but today we have Laurence has showed me a list of more than 140 volatility controlled or hybrid or bespoke or exotic or balanced. I'm not sure whether they all mean the same thing or they're all different, that are created by the options desk we're going to have to sort that out. We were created by someone at investment banks and are also available to insurers who issue FIAs. Now, okay, now I'm just going to give you free rein there, Laurence, to tell us about these volatility controlled indexes before we and to handle some of these basic questions.
Sure. So I think actually volatility controlled indices began probably about 20 to 25 years ago, and they mostly came out of Europe, and they were being used in structured products. And some American investment banks based in Europe and S&P popularized this methodology, and it's called risk control. And really what it aims to do is provide a much smoother ride on an index. So it aims to buffer the volatility and avoid large drawdowns. So now the way it does this, in a very simple example, you might have an equity index and cash, and a vol control index just simply toggles between the two. And the signal it uses to switch between the equities and cash is volatility. And essentially what it does is when volatility is high, and that's when markets are dangerous, basically says, well, I don't want to put too much money into the equity markets because they're risky. So it decreases the exposure when volatility increases, and vice versa. When volatility is low, that's normally good for risky assets or equity markets. And then the index will increase its exposure to equities. Mm-hmm. So that's really how they work. Now, where do they add value? And I think these indices are incredibly valuable because what they do, as I said, they provide much smoother returns. And in some of my analysis, we've gone back and looked at these volatility controlled indices over the last 10, 5, 3, and 1 years. Mm-hmm. And in almost all instances, about 90% of the time, we find that the Sharpe ratio of these indices is better than your benchmark. Mm-hmm. So I feel that the Sharpe ratio is a good measure. And I know that sort of might be complex for some people, but essentially the Sharpe ratio is a simple way to think about it. You're looking at your returns and you're looking at your volatility, and you want to understand how much return am I getting for the unit of risk. And these indices do a great job of that. And the reason they do that is because they're very stable and they avoid large drawdowns.
Mm-hmm. Okay. And our viewers may have experienced them before if they used variable annuities. Was that a little different in the early 2000s or after the financial crisis when you started to see the Valmark vol controlled indexes? Was that the same thing, or is that something a bit different?
I think these indices began to become more popular after the financial crisis. Mm-hmm. And really what had happened was that pre the financial crisis, mm-hmm. interest rates and credit spreads were very high. So if you remember, we had a Fed funds at 5%, mm-hmm. credit spreads were very healthy. So you had a very high spread, mm-hmm. and that meant the insurer could had a good budget to buy these indices. Mm-hmm. Mm-hmm. However, after the financial crisis, we saw credit spreads came down, interest rates have come down, mm-hmm. and their budget decreased. Mm-hmm. And that's when the explosion of popularity of the risk control indices took off, because these indices are typically cheaper to buy, mm-hmm. And then that's why they became more popular, because the budget was decreased.
Is this the same as CPPI, I'm forgetting what that stands for. The
Constant proportion in
portfolio insurance. Yes. Is
it's
that
a little bit different. I mean, the CPPI works like you have an option budget,
Mhm.
and or risk budget, and you invest what you can afford, and you have something called a bond floor.
Mhm.
And those were, you're right, pretty popular pre the crash. But I think with interest rates that are now so low, that they've fallen out of favor. And essentially the problem with CPPI is that when you had rates of 5%,
Mhm.
the bond floor might have been 60.
Mhm.
You're trying to invest $100. That meant you had $40 to invest in the market, and you could generate good returns.
Mhm.
But now the bond floors are maybe at 90%, and you only have 10% to invest in the market. So it's just very little. So that's why risk control indices have superseded the CPPI structure.
Mhm. And Tamiko, how do you support, where does CANNEX enter this picture in terms of helping people answer these questions?
So this is, really part of our roadmap in terms of adding the wider variety of indices to our services. So we're in the process of doing that right now. But we've been working with Laurence on doing some custom analytics around this. And I just wanted to jump in on the VA question. So yes, we certainly have seen vol-controlled indices in VAs, but the genesis of that trend in the VA industry was more around volatility overlays or strategies. So looking a little bit different for the most part, but we certainly did have seen them quite a bit with the VAs.
Okay. Now, this was a fascinating chart that you had in your guide to volatility controlled indexes, Laurence. Can you tell us what's going on here?
Sure. So, I think this shows some of the value that a risk control index brings. So what we see in the dark blue line is standard large cap equity. And then the orange line is a 10% risk control index. And what you can see in 2008, that the orange index fell a lot less than the large cap benchmark, right? So that gives you the smoother returns and the lower drawdowns I was talking about. And then again, you can see in the most recent crisis, the markets had a tremendous drop, and the vol control indices didn't drop as much. And what we did recently at the Index Standard, we took a look at all the risk control indices over March 2020, which was probably one of the most stressful periods that we've seen in recent memory. We wanted to see, how did these indices do versus the S&P? And what we found, Kerry, was that the S&P fell about 34%, but the risk control indices as a group fell about 9%. So, there are some skeptics out there who might say, well, I don't trust them. I mean, here was an example of a stressful scenario where these indices only fell on average by about 9%. And, that there shows the value. If you were an end investor and you had to cash in your policy in March, April, or May, bought the S&P, you would be in for a nasty surprise. So I think these indices help you sleep better by the fact that they provide smoother returns and lower drawdowns. So that's really the value that they offer. And this methodology, as I said, it's been around since the early 2000s. It's probably almost 20 years old, and it's actually a very stable and robust process that I think has been proven, and the results that we saw in March 2020 demonstrate that.
Yeah, and as we spoke about before, it would be interesting to see the bond total bond market return or something like that would come in below, probably what I've heard is roughly 2% below well, it depends on how much the risk control level, right? But so the return would come in below that, depending on the separation would depend on what exactly the risk control method was.
Exactly. And so I think if you were to add a bond overlay here, you would see that the ag, if you add the ag, it would be lower, and it would be more stable. But here's the important thing that I think we all need to remember, Carrie, is that we're coming off a 40-year bond bull market, right?
Mm-hmm.
So that bond index has incredibly stable returns going up for the last 4 decades, but that's not going to happen going forward because rates are now so low that actually your potential to lose money from fixed income is very real. And in some of our forecasting work that we do, we analyze expected 10-year returns from the market, and we see the market expects the ag to have very low returns and almost at zero. So if you invest in fixed income right now, that's the reality. The next 10 years, you may get sort of circa less than 1% return. But that's where I think the risk control indices, whether they're packaged in a structured product or whether they're packaged in an annuity, have real value to add because they can be an alternative to the fixed income market as well.
So that's what we're really, as a practical matter, that's what we're really talking about, is using these as a bond substitute.
Yeah, that's one way you could see them. They can really be the anchor in a portfolio.
Okay. Now, as I've researched this, a number of questions came up. The one is there's a price return index and there's a total return index, and it seemed like this is something that buyers should be quite aware of. And could you explain the difference? It's pretty simple, I guess.
I'll keep it simple. So the one thing that people tend to forget is when you're buying these popular benchmark indices in an annuity, such as the S&P or the Russell or the NASDAQ, they're all price return. So what does that mean? That means that the dividends are not included. So that's actually quite important because dividends are a key component of returns. In the last 100 years, equities have returned sort of circa 6%. But about 2% of that is actually due to dividends. So you're losing out on the dividends. So that's the weakness that people tend to overlook, and it's not often stated in the documentation that you're not getting dividends.
But now, there's an upside to that, though, isn't there? You get something for giving up the dividends.
Correct. It makes the option cheaper because the bank will actually collect those dividends, and then that'll make the option price a little bit cheaper. So that's what you're getting. Now, an excess return index, what it is, essentially, it's normally an index that will include dividends, but it will take away a borrowing cost, and you will get the net of that borrowing cost. So why do banks do that? Well, I'll tell you why. So you can imagine the insurance company is buying an option from the bank on a risk-controlled index. So when they're buying the index, the insurance company, let's just say they wanted to get exposure to $100. They might give the bank $2 or $3 in exchange to buy that option, right? Now, how does the bank generate money? Where do they find the money to go and buy the index or the ETFs to hedge that? So what the bank has to do is they need to borrow money from their treasury, and then they'll go out and buy the S&P or the NASDAQ or the AG, whatever the blend is. And they have to buy it in a proportion to hedge the option. So, and that's not free. So the bank has to essentially borrow money to buy these instruments. And then that's where they pass on that borrowing cost. And that's called an excess return index.
Now I've seen them, like Bloomberg dynamically something index, and then have it be the ER version and the non-ER version in the same contract. And then when I went to read the fine print on the ER, it talked about futures, and suddenly I was out of my depth. So what does the distinction mean to an advisor and client? And if they're sitting there side by side and they have different caps or participation rates, how am I to deal with that?
Yeah, so what you would imagine that a total return index will probably return more than an excess return index, because the total return index includes all dividends, and an excess return is extracting a borrowing cost. So that's why the total return index will return more. Also, the option on that index will be more expensive. So that's why I would imagine if you looked at the par rates or the participation rates, you would see that they would be lower for the total return index versus an excess return index carry.
It's not the most transparent thing in the world.
No, it's not. And I'm trying to explain everything in clear and straightforward language. And I think that's actually one of the problems that our industry faces, that it is a complex area. And how do you decompose this complexity and make it clear for everyone? And in a way, that's what the index standard is trying to do with our ratings. We're trying to very clearly help the advisors see what an index is by giving it a rating of platinum, gold, or silver. And we also briefly describe it. So we're trying to help people understand this complexity.
Now, Tamiko, do you provide explanations of all of these indexes to your clients?
No, that's really in Laurence's realm and the index standard. That's one of the reasons that we're really excited that he's coming out with his, or he has come out with a service. But we've done a lot of work on analyzing how these things function and trying to understand the value that it potentially brings to a client, and really validating and understanding that from the perspective of how the index interacts with the annuity structure, which is really important because so far we've been really talking about the naked index, and the return for the client is a combination of the index actual performance with whatever the structure happens to be for that crediting method.
Yes, I think we'll get into that in the questions on the next slide, about that you're not looking you're seeing the index through an additional lens. So we touched on this when we talked about your graph. What should an investor expect from volatility controlled indexes? And before you answer that, I'll just throw out, is it indices more correctly than indexes? I've been reprimanded both ways.
It's a style sheet thing.
I think it depends where you come from.
Either way.
I think the Americans prefer indexes and the English people prefer indices. So as you choose, tomatoes and tomatoes.
I've used both.
Yes, but tomatoes and tomatoes are spelled the same way.
Yeah, depending on where you come from, they're pronounced differently. But
okay, so we touched on this in the graph. They don't really. What should an investor expect from these indices? Some people have sworn, that in certain years you can hit it big. Is that true?
So, I think what you should expect is a couple things. You should expect a much smoother ride. You've got what the name does, it aims to control the volatility, and you should also expect lower drawdowns. Now, in terms of your returns, that really comes down to the target level of volatility. So what that means is if you have a high level of target volatility, versus a low one, an index with a high level of target volatility means it has a bit more room to provide more fluctuations and more movements, and it'll invest more in the underlyings. So therefore, it has the potential to provide higher returns because it has more scope to do that. Now, the sort of issue is that an index with a higher target volatility will cost more in an option. So without getting too complex, the key thing that drives an option price is the volatility. So the higher the volatility, the more expensive it will be. And, as a trend, what we see at the index standard, we've seen the target volatility level decline over the last couple of years. And that's really because credit spreads and interest rates have been declining, and that the option budgets that the insurance companies have been declining. So therefore, we've needed cheaper options, and therefore we've seen a trend to lower target volatilities.
Okay. And then the question, and then most of these newer indexes, they have no real history. So some people are a little bit skeptical of the back testing. How do you know? This is an industry really where you have to know who you can trust with the data, because there's going to be lots of data that you won't know the validity of until the it comes out in the wash, in the performance. So, can you throw a little light on, is there more than one way to back test this? I mean, what is the kosher way to back test an index with no history?
Yeah, so it's very difficult. And what we do is we really want to look at an index against its peer group, Kerry, and see how it performs. But then I think there are a number of ways that you can dig in and look under the hood to identify what's going on. And some of the key things that we would look for is, in this case, how complex is the mechanism? And what I generally believe is the more parameters you put in, the better back test you're going to get. But that means you've also optimized your index to the past. So it may not perform as well going forward. So if I see an index with a lot of parameters, I tend to worry a little bit. So that's one aspect that we look at. The other aspect that you can look at is really the diversification. You really want to make sure that the index is well diversified across, single stock risk, sector risk, country risk. So that's another aspect that we look at. And then, I want to understand, are the rules transparent? Is the index independently calculated? Is that calculator, do they adhere to the OSCO principles? So those are some of the aspects that we would look at. And we also look at a tremendous number of statistical sort of factors and parameters as well. And we also look at how long that index has been live, because the longer it's been live, the more we believe in those statistics. So that's the way we think about an index. And we're really trying to identify, an index that is robust and well designed in your group as well.
And Tamiko, you mentioned about the overlay of the crediting method. That seems like it would, by putting that lens over the index, that as well as I understand the index, I'm not going to get a pure return on the index. I'm going to get what I'm allowed to get. And some people feel that, that sort of levels all that through the crediting method, there's a leveling effect of all of the methods. So all the indexes. So what you get on the index, it might be taken away in the crediting method, because after all, the options budgets are the same. I'm not sure whether they all are the same, but could you address the idea that the crediting method does not sort of take back what the index gives?
Yeah, I understand where that might come from, particularly if you're just looking at the rates. But the underlying build is, you say is the same. The options budget is, it's going to be there, that it's a set budget, right? And then don't forget that insurance company, has like fixed costs and so forth that they've got to account for. I just want to mention, I always like to mention that there are, everybody is covering their costs, but within that option budget, there are two dynamics. One is that pricing issue and the fact that the volatility is directly related to the cost of the option. So the lower the volatility, then, the more of that option you can purchase, right? And the other dynamic is that sort of that pass through, that there's like the filter of the crediting method itself. So one of the things it does on an FIA is it, cuts off the bottom. So everything below zero, you're losing those returns, right? And then, the other question is what happens on the upside. So when we look at the return of the index, we often think of the net return, and that's how we analyze them, over a longer period of time. What would you get if you held on to this thing for 10 years? But it's really quite different once you do that pass through, because on a periodic basis, there's that gate of what has happened at the end of the term. And so what is the actual return? So one of the effects that you can potentially have outside of being able to get more of the option within the set budget is the fact that if you have fewer times when you're getting below the zero, right? And you have some kind of return that manifests either, when you have a cap, for example, you're within that cap range. And then when we look at really high returns on an index, when you have a cap, everything above the cap is it doesn't manifest in the return that the client ultimately gets. So
Mm-hmm.
that's one factor, right? And you know, with a par, it's whatever sort of the cut is. There's like a standard haircut percentage that's taken off of that. But you know, really reducing the number of times you're hitting zero over the period of time that somebody's holding that annuity really matters. And we can see that if you simply reduce the volatility, you actually can get better returns. And then that's not even taking into account the fact that you could potentially have a higher cap or higher par, you know, by using one of these indices.
Okay. Now I jumped ahead. I may have jumped the gun on some of these questions. The first one we have looked at, if the original options budget is the same, shouldn't the expected returns be the same? Maybe I didn't ask this in this particular way, but that's that I've heard that quite a bit. If the options budget is the same, your now there might, you know, there's always unpredictability that's going to, you know, scatter returns around, but the expected return would be the same because the bet and people, you know, the advisors and those who follow the industry, you know, you grow up with a believing that all advantages get arbitraged away before you get to them, and that, I think that drives part of this prejudice. And so, but you're saying that it's not, and does that mean that you can identify, and that suggests that there are some indexes that are going to do better than others with the same options budget, and can you identify them?
Yeah, so I mean, I think, you know, I'll build on what Tamiko has just said. I think the way I would think about it is it's really around volatility. So if you think about the S&P, it's got a historical volatility of, let's say, 18%. What does that mean? I mean, what it means is you've got a wide range of outcomes. And of course, some of those outcomes are going to be negative, and you're getting cut off. But if if that index that you buy, it ends up being negative when you're redeeming, you know, you're going to get zero. So that's the key thing, to remember that the S&P has a very wide range of outcomes. If I look at a risk control index, it is a very narrow range of outcomes. Because that volatility is controlled, you reduce the range of outcomes. And because they're much more stabilized, you know, they try and cut down some of this downside. So on a probability basis, they actually have a good chance of coming up and doing well because of they control the volatility. And therefore, that's why you can, you know, they can do better. And the other sort of point is because you can actually effectively get 150 par rate on some of these risk control indices, you can buy more units. So, you know, if they're returning 5% and you get 150%, you can actually get 7.5% potentially return because of that, the cheaper options that they produce. So those are some of the benefits. And I think the key thing that people should remember, it's really around this volatility, that high volatility means a wide dispersion of outcomes, and a low volatility means more controlled, more certain outcomes. And that's really what you want.
Is there any relationship between the volatility target amount, 5%, 10%, and the return levels? Is there, at first glance, I found myself, you know, starting to believe that.
That's a great observation. And what we've seen in some of our analytics is that really the return, you're getting about a Sharpe ratio of around about 0.6 to 1% on these indices. So that really means that, as you say, you're actually getting around about the target level of returns. But I think that the other thing that people need to remember is, unfortunately, we've just come through a tremendous period of history for returns. The S&P has had an incredible run of 15, 16% annualized the last couple of years. And if I look forward to some of our forecasts and the wisdom of the markets, the market is predicting the S&P is going to have around about 5 to 6% return. And then, as I mentioned earlier, we've seen tremendous returns for bonds. Again, because interest rates have come down. and now we're projecting that, returns on the ag will be, in the order of like slightly lower than 1%. So we all have to accept that we're in a lower return environment as well.
Mm-hmm. Now,
Carrie, can I just, I'm sorry,
sure.
I just want to jump in on one other point around
Sure.
the effect of the low volatility, which is around renewal rates. So, we're really talking about the index and the annuity structure, but one element of the annuity structure, it's also how long you hold it for. And when you buy that annuity, you may get it and say, oh, this is the rate today, but that rate may change in subsequent years. But one positive effect of using lower volatility indices is that because you have much more stable options rates or options prices, then you can actually provide much more stable renewal rates, as opposed to more volatility sensitive indices like the S&P 500, where something really crazy happens, you may all of a sudden like really get that cut down in subsequent years. Although carriers really do prefer to have a more stable rate. But if you're, you have to remember that if you prefer to do that, then you might actually be modifying that a little bit in year one, saying, oh, we're going to sort of hedge our bets on that. There are a lot of different ways to manage it. And it's, I think the idea of having a more stable rate in general is very beneficial to the client, because you have a better expectation, of what you're going to get down the road. But it's a lot easier to do this with low volatility indices, where you're not having to say, we're going to hedge our bets here. So, this is just the price, and it's going to be relatively stable over time.
Well, that's very significant, because one of the objections to fixed index annuities for years has been the possibility that you'll get a bad renewal rate. And so that would remove removes a huge obstacle for some advisors to the use of the product. Exactly. Now, the next question involves the belts and suspenders. I'm looking at these products. I'm seeing like a 6-year term, which is a diversification issue, and I'm looking at the FIA no loss guarantee, which is another safety net, and then looking at the volatility control and I'm just seeing a lot of belt, suspenders, and life vests. And so, and then I wondered, is this all necessary? And I hear you saying that it is necessary because it gives you a bigger options budget.
I don't know. Are you asking me or Laurence?
Either one of you.
Well, I'll start since I'm already talking. But, I do think that there's a value. And I'm not going to say something's necessary or not necessary. If somebody wants to invest in the naked index and they think that's an appropriate choice, I mean, Laurence does, evaluations of the index on its own too. So, but the point is really that the risk profile of an FIA is that you're never going to lose that principal, right? And that there are other components baked in, particularly depending, if you're able to invest more than 100% in that index, then you're really getting a very different value proposition.
Yeah.
Okay. And Laurence?
Build on Tamiko's point. I think, kind of the benefit of the stable volatility and the consistency and the pricing on the renewal rates, that can't be overstated. It's incredibly valuable. And, what the sort of payoff is, you're having to deal with a little bit more complexity. And, we see many indices that might use a mean variance optimization technique to sort of combine the underlying constituents in a very stable way. And then it'll wrap it in a vol control. But what you're getting is real stability, and the volatility is very controlled. And what we did was, at the index standard, we took a look at the sort of 10-year volatility of a lot of these indices, and then we compared the realized volatility to the target volatility. And what we found was that 79% of the volatility observations were between with minus 0.5% and plus 0.5% of that target vol. So that means that they're really like they are absolutely delivering on their target volatilities. And it means the option profile is stable, and the banks and the insurance companies can provide consistent renewal rates. And that does come at the expense of a little bit more complexity, Kerry.
Mm-hmm. Now, another spitball that's blown at these products is the illustrate well. Well, they illustrate well. Okay, then that's what they're supposed to do. And what's your response to that?
Yeah, I mean, that's the issue. I mean, a couple points. So I would say, that criticism could have been especially valid maybe 10 to 15 years ago. And what we see today is some of the index design techniques are incredibly sophisticated. So advisors should understand that you're getting institutional level portfolio techniques such as mean variance optimization and risk control packaged up for you.
Mm-hmm.
And the banks really want these products to do well, because if the index does well, the bank gets more hedging notional.
Mm-hmm.
But the banks are also putting these indices through incredible due diligence. So for example, they would normally have 3 committees to review the underlying methodology and the structure, check that it's suitable for retail.
Mm-hmm.
They would also then have their risk department, their legal department, and their compliance department dig in to make sure that they're robust and there's nothing funny happening.
Mm-hmm.
And in actual fact, one bank recently told us that their chief risk officer for the whole bank has
Mm-hmm.
to sign off on each index.
Mm-hmm.
And another bank told us that they're getting a large 4 auditor to actually review every single index and all their calculation points. So
Mm-hmm.
the banks are taking this tremendous amount of care and due diligence.
Mm-hmm.
And it's in their best interest to design an index that performs well, because they'll get more hedging notional. So
Sure.
they absolutely want these indices to be robust and do well.
Mm-hmm. Well, the pattern in the industry has kind of been that when things first start out, they're kind of wild and woolly, and that gradually they get formalized and rules based, and now the last one we handled, the next question about risk and reward, I think you addressed that when you talked about the Sharpe ratio. The Sharpe ratio is sort of an indicator that that risk and reward are not necessarily locked into an inverse relationship.
Yeah, I mean, so I probably designed my first risk control index in 2006, and I love them. I mean, I would recommend them to my grandmother and my mother, because they've been around for 20 years, and they really have done what they're supposed to do. I mean,
Mm-hmm.
look at March 2020 when they fell 9%.
Mm-hmm.
So if you look at them on a Sharpe ratio basis, which is the way you should do it, because if you just looked at returns, obviously the S&P is going to beat it.
Mm-hmm.
But you need to think about your ride, right? Or did you have a volatile or a smooth ride? That's
Mm-hmm.
actually very, very important. And, we've seen the S&P 500 in March 2020, the volatility was 80%, fell 34%. If you had invested in that index, you would be worried at that point in time. Whereas if you invest in a risk control index, 9%, at a much smoother ride. And then, as I said, we've seen the Sharpe ratios over 1, 3, 5, 10 years are all generally much stronger than the benchmark indices.
Okay. And then the last one, what I mean by that, and people have mentioned that to me, is that maybe the index doesn't rebound when or the crediting method and the index combined don't rebound when the underlying assets of the index rebound. Is that the problem?
Yeah, it can be a problem, and it was especially a problem in the early days of the risk control index. What would happen is the markets would crash and they would sort of de-lever, and then they would have a very low exposure to the risky asset, and then markets would go up and they would lag. And that's why you see a lot of risk control indices have got a bit of leverage. So when the volatility is low, they can add more and catch up. But then, to your point about oversedation, you're absolutely right. And this is something that you should be very careful about. And I'll give you an example. If you think about an equity index, let's just take a simple example. Let's say the equity index has got a volatility of 20%. And if you have a target volatility of 5, so it becomes 5 divided by 20, which is 1/4. That means you're only investing 25% into the equity index, which is a small portion. And then, your fluctuations are going to be very small, and you're going to probably not get great returns. So that's, you're right. you have to think about the underlying index and what is the suitable target volatility for that index. And it's clearly to have a pure equity index at a target vol of 4 doesn't make sense. So yeah, you're right. They can be oversedated.
Okay, I hope everyone out there who's viewing is following all this, because we're getting into rocket science territory in a way here.
Sorry, I try to keep that example simple, Kerry.
Okay, before we go into Q&A, I'd like to give you both a chance to sort of round the circle and say, okay, you guys are obviously all over this topic, and what can you do for the people who are watching? We have a variety of people on, I think, from the platforms that distribute this stuff and the broker dealers to individual advisors and also issuers. So where do how do they take advantage of what you do?
Tamiko, would you like to go first?
Sure. So, our rate services and analytics are available to our clients, distributors, and through certain other platforms. But we are working on this issue of the hybrid indices.
Mm-hmm.
We're really expanding our capabilities in that regard. And right now we're doing a lot of offline work with that. And we've been taking a look at really how they perform.
Mm-hmm.
So that's what we do.
And at the Index Standard, what we're trying to do is really help advisors and end clients understand the indices and with what they're buying. And we do this in a couple of ways. So for each index in the FIA and the RILA space, we actually produce a rating report.
Mm-hmm.
We'll rate each index and give it a platinum, gold, or silver, or so on.
Mm-hmm.
And we describe what we think about the index. We describe how the index works, so the advisor can get an easy snapshot of here's what I'm selling and here's how it works. And then we show a variety of performance stats, and we also analyze, what underlying exposures that index have, and we show that in a bar chart, so you can just very visually see what is this index all about. And what we're finding, Kerry, is that people are coming to us for two particular reasons. We're finding people are asking to look at the reports to help on the sales side, to say, I want my advisors to understand what they're selling, and we can look into the index. So that's one area that we're getting traction. But the other area is actually also on the fiduciary and best interest side. Because we rate every index in the market, we can track how they do, and we can help advisors and agents and insurance companies when they're effectively selling these products. They're making a recommendation, and we can track those over time and show how your particular products, and that can become a tool or evaluation tool that you can use for your sales process to verify that you are striving to meet these standards. And it seems to me that these standards are only going to be strengthened under the new administration. So those are the two particular areas where we're helping people. And then just very quickly, finally, with our forecasts, we try to help people look forward. When you're driving a car, you want to look through the front mirror. You don't always want to look in your rearview mirror, because that's the past. So our forecasts, we use the wisdom of the crowd and some broad brush, sensible techniques to help project returns, provide a range on that. So we're trying to provide guidances to people as to what they might expect, and that helps them select between index A and index B.
So you forecast as well as back test?
Yep, we do. We provide forward-looking projections, as and another way to think about it is, Kerry, is Tom Brady has won 7 Super Bowls, but do you think he's going to win 7 going forward? Well, yes. Probably not. We intuitively know that. Maybe. So maybe you want to buy Patrick Mahomes because he might be the new superstar. So we try and help people make that judgment with our forecasts. We take about 30 asset managers, their forecasts, we average them out, and we run some techniques, some statistical techniques to project returns. We provide a range of those returns because it's very difficult to project. But by doing everything in a rigorous and analytical and consistent way, and we treat each index the same, that helps us think about the future. And you certainly want to look through on your front mirror when you're driving a car.
Okay, I think we have a couple of questions out there. Let me can you speak to the index rate lock on uncapped strategies, and they're referring to a particular product, I think, or line of products, particular issuer. Doesn't this help mitigate leveling inherent index strategies? Not sure I understand. Is that clear? Doesn't this help mitigate leveling inherent index strategies?
So Tamiko, you're the insurance expert.
Yeah, I'm just not sure about the use of the word leveling in this situation.
Well, let's talk about the rate lock.
Yeah, I mean, this really speaks to the issue that you had brought up, around, well, I originally phrased it, but, around renewal rates, right? And the importance of having that kind of consistent rate. So yeah, I mean, I think that it's very attractive in the market. With Allianz, I actually can't recall if what indices they're using. I do know that the New York Life product, which is technically on a variable annuity chassis, but looks a lot like an FIA, they're doing it on the S&P 500. But Allianz may be using another index. I feel like they are. In which case, it's certainly a lot easier to manage. It's a less complicated calculus, and there's obviously a lot of value to the end client. So
what would that value be?
Well, I mean, just the reliability. Say, well, I know that this insurance company is promising to keep this at the same level, and like I say, with some of the other indices, it's much more reliable, and there's less doubt about that, and especially the idea of bait and switch. I'm not suggesting that that's what the carriers are doing. And the best way to know what they're more likely to do in the future is to see what they've done in the past. By the way, we don't have that data, but that's one way of kind of understanding how the carriers tend to manage their businesses, because they all manage it differently.
We have another question. If I'm buying an FIA, the worst I can do is 0% over a selected period. So why layer on a risk control index? Doesn't that just turn the FIA into a regular fixed annuity? So are people getting the same rates from regular fixed annuities that they're getting from a FIA with a volatility control?
So Carrie, I'm going to start by saying that, when I'm talking about the potential utility of a lower volatility index and like the fundamental dynamics, I'm speaking in really general terms, not about the specific index. And it's one of the reasons that Laurence's work is so important, is to understand those, like an individual index that somebody will be encountering in the marketplace. So there are multiple variables. There's the actual index, how it's designed, how it is likely to perform in the future, how it has performed in the past, right? As well as the specific structure and the rates. And these are not the same, right? They change based upon those designs. And so I think that what this question really gets at is some of the issues around conviction and what are the goals of the client. If I really said, I don't mind getting 0%, but I really want to, shoot for the moon, and I want to get the highest gain that I can when the markets are booming. And that's really trying to pull in, combining the higher volatility type indices with this protection. I think that is certainly it's a common strategy, and it's obviously a very legitimate one, because that's how many people have been buying these products. And that will give you a certain return profile with a certain risk associated with that you might actually do worse than a fixed annuity. We've done some work around this as well. And so, the idea of lowering that volatility and getting that more consistent performance, it's about the consistent performance. It's not about trying to shoot the moon. So I think that this is a conviction aspect. And again, this is why the forecasting is very helpful, as well as the individual conviction of any financial professional that's making these recommendations and what their clients are expecting or thinking is going to happen. Say, okay, well, I'm going to match how we're allocating within this product according to what you want or what you believe or what I believe.
Okay.
And if I could add one further point there, I think, essentially what these risk control indices do, they avoid a large potential for negative returns. And that's really important, because imagine if you were redeeming your product in March or April 2020, right? You're going to get zero. So, and then if you had a risk control index, the possibility of getting a higher return exists. So these risk control indices, as I said a little earlier, they really cut down the possibility of wide returns, and they help skew your returns to the positive side. And that's a huge benefit by cutting off some of those tails of large potential losses.
We have an additional question. It says the proprietary, and this is not something we've addressed yet, that proprietary index market has become very saturated, says this listener, and additionally, the indexes have become increasingly complex. In the bank channel, banks have been very hesitant and even threatened to kick a product off the shelves if it adds a new proprietary index. Now, is there a distinction here between proprietary index and volatility controlled, or are they the same thing? Or
I think, to my mind, they're the same thing. But I think it's an observation that I've heard a couple of times recently as well, that people are concerned about the complexity, and that's why we founded the index standard, to help people cut through the complexity and understand them. But also, I've referred to the way that the banks and the index houses are designing these indices, and the rigor and the strength that they and the processes that they put these indices under. And I think there's still some skepticism out there, and but look at 2020 when they did incredibly well. So I think it's just a question of education and informing people about the benefits of these risk control indices, and that's what we're trying to do at the index standard, is really help educate people. And we've got some guides on target volatility. We're writing some op-ed pieces about how they perform in the market. So we're trying to help educate the market as to the value that these indices can bring. And then, what's the alternative? The alternative is you put all your money in the S&P. The S&P is right now got a CAPE ratio of 37. That's one of the third highest at all levels. It's got about over 40% is in technology. If technology gets regulated, maybe the S&P is not going to do as well. And for your clients, you want them to have diverse exposures with different factors, different asset classes. And that's where the risk control indices have a really important part to play.
And our last question here is that does CANNEX or the index standard provide sales flows for these funds? I think the answer is no.
Right? No, we don't do anything around sales. But I just want to touch back on this other issue of the proliferation of these indices. And there are a lot of them. And in many cases, they're a particular insurance company will use an index and then nobody else is using that index. And so it's not like everybody's using the exact same tool. So I certainly understand not just the basic skepticism around the fundamental concepts, which is really what I've been talking about. But the fact is, how can you tell that something is really bringing value to the client? And I think that, we certainly recognize this gap and the fact that there is a lot more information, not just on the overall principles of it, but the specific performance of individual indices within a set structure, right? But there is an aspect when it comes to the relationship between the index provider and the distributors of getting them up to speed on how these things are built and all the stuff that Laurence is talking about. But that is a less visible aspect of it, and getting everybody comfortable. But I think that there are a number of different touch points where we can really improve. And I think it's worth it because there is a value to having a variety of different options on the market, as far as, even within the scope of FIAs themselves, having different indices and structures. But, right now, interest rates are so low. And, they were low before the pandemic. This is kind of a persistent challenge. And it doesn't just affect FIAs, but FIAs are one way to give people a little bit more yield, but they may not want to assume the same risk of that yield not being great if an equity index has multiple negative years, right? And so this is where that really fits in, I think, and is a valuable component potentially to somebody's portfolio.
Yeah, I think that we should make the point that everything here has to be considered in the context of the goal of the investor. If their goal is in 5 years from today to have at least this much and hopefully a little more, but the safety and the is the primary thing. I mean, these products certainly serve that purpose. They're not a backdoor way of turning of getting some kind of free lunch from the equity market. So they have to be looked at in that context. And certainly for retirees or near retirees, the idea of having something that's fairly predictable over a 5-year or 10-year time horizon is a need that has to be addressed. And these products and others address that need. Okay, I think we're out of time here. Thank you. Thank everyone. I thank everyone for attending. I don't think we've barely exhausted this subject. If you look at a couple of the June 4th, June 11th, and June 18th issues of Retirement Income Journal, which are online, also address some of these indexes about the index, these issues about the index, and I can direct them to you. And we will have a recording of this will be available if you'd like to have it for further reference. I hope the two of you, I'm very grateful for you sharing this time with us. It's an important topic. It's kind of a rarefied topic, but I think it's at the heart of the annuity market today, and we have plenty of territory to cover in future webinars. Thanks.
Thank you very much, Kerry.
Thank you.
Thank you, everybody.